to implement them. And if the government fails to implement them, then I think the growth rate could, in fact, be slower. But I'm reasonably confident that enough structural reform will be done to sustain growth through the remainder of this decade. The third point is that when you look at the composition of growth in China, as Ambassador Amaral mentioned, historically China has had a very investment-focused economy, but we are already starting to see a very marked slowdown in the traditional investment and drivers of growth, and something of an acceleration in the consumption side of the equation. So this is a process, we're not waiting for it to start, it's a process that's already begun. It's begun from the bottom up, and what is required is some additional policy support from the government, but it's happening in any case. Fourth point is that even though we're moving into a phase where investment growth will be much slower, consumption growth will be much important, the level of investment in China will remain extremely high for many years to come. And that's an important message for countries like Brazil, which are linked to China in part through a very strong commodity export business. And I think the message there is that while the growth in China's commodities demand is going to be a lot slower in the future than in the past, the level will remain at an extremely high, at a high level. And the final point that I want to make, and this kind of gets into the nuts and bolts of how change occurs in China, is that we're already seeing a very dynamic process of financial liberalization in China. This is occurring very rapidly. This is a necessary component of this change from capital mobilization to capital efficiency, and from an investment-driven to a consumption-driven economy. And again, this is a bottom-up process that has been driven much more by private activity than by government policy. But I think this, the financial market also illustrates some paradoxes in the Chinese reform process, namely that in the past, a lot of Chinese reform has been driven by opening up the economy to the external world. That was the key insight of Deng Xiaoping 30 years ago, that to reform the domestic economy, they had to open up to investment and trade. And the continued openness has been a key part of Chinese reform efforts. I think we're now unusually in a situation where the progress of domestic reform in some respects depends on becoming less open or not opening to the outside world, because China is basically trying to do the opposite of what most of the other major economies in the world are trying to do right now. Most of the major economic areas, the US, Europe, and Japan, because they have such huge debt problems, are trying to keep their interest rates at as close to zero as possible. And this is a process known as financial repression. China is trying to do the opposite. They've had a policy of financial repression for the last 10 years, which is what's helped them finance their investment growth. And now they're trying to get out of that and move to a situation where interest rates are driven more by the market. And if you're trying to raise your interest rates when everyone else is keeping their interest rates at zero, you can't allow free flows of capital, because if you do, then everyone in the world will take their money out of the US, Europe, and Japan, where they're earning no return, and bring it to China. And that will create some big problems. So China is in a rather unusual situation for the first time in its history, actually, I think, where a key component of reform, of domestic reform, is probably not going to be aided by increased openness to the outside world, and in fact, it could be retarded if there's too much opening too fast. So that's the general idea. I just want to go through a few of the major points in a little bit more detail. And I want to justify why we think that China can continue growing even at a rate of 7%, because there are plenty of people out there who have a much more pessimistic view, say that China has overinvested, It's not an efficient economy, and there's basically no way that it can sustain its rapid rate of growth. And we have a lot of reasons for disagreeing with that pessimistic view, but I'll just focus on one, which is that the Chinese growth model, which has basically been built around export promotion of manufactured goods, heavy investment by the government and government-linked entities in infrastructure, and interest rates and exchange rates that are kept below their natural levels in order, in the case of interest rates, to subsidize infrastructure spending, and in the case of exchange rate, to subsidize exports. Okay, this is a recipe that the Chinese did not invent. It was invented arguably by Japan after World War II, and it was part of the Japanese miracle from the early 1950s until the 1980s, of very rapid growth. That model was copied pretty much by Taiwan and Korea, and the most successful sustained growth stories since World War II in the world have been the stories of these three economies in East Asia: Japan, Taiwan, and Korea. And the way we measure this is just by comparing the per capita GDP of these countries to the per capita GDP of the United States. So you can see in Japan's takeoff area, it moved from a per capita GDP that was only about 1/4 of the U.S. level to about almost 80% of the U.S. level. Then things slowed down a bit, and then it continued to rise to 90% before finally difficulty set in. Similarly, Taiwan and South Korea, they took off a little bit later, and they rose from about 20% of U.S. GDP to about 50 or 60% of U.S. Per capita GDP before they experienced a significant slowdown in their convergence with U.S. income levels. So the basic idea we have is that there's a fairly straightforward catch-up growth process that was used by each of these three countries. And China is basically doing the same thing all over again. This is a tried and true recipe. It's worked very well for its neighbors. And so China is doing the same thing. And where are they in that trajectory? Well, they're not very far at all, actually. They're only at about 20% of U.S. income levels. And it's very difficult for me to believe that there's some special reason why China, following essentially the same policy mix that Japan, Taiwan, and Korea did, why their convergence with U.S. income levels should suddenly stop right now. I think it's much more likely that China enjoys another decade or so of growth at approximately this 7% rate. And if they do that for another 10 years, then they'll get pretty close to 35 or 40% of U.S. income levels. And I think for a country of China's enormous population, that's probably a natural inflection point where the convergence with U.S. income levels will start to level off. But right now, they still seem to be in a position where very rapid growth is certainly quite possible. Just because something is possible, of course, doesn't mean that it will definitely happen. And my analysis is that in order to achieve this continued rate of growth at around 7%, you can't simply rely on momentum. You have to undertake some structural reforms that improve the efficiency of capital. So basically, the only way to maintain the growth is to restructure the economy so that for each dollar that you invest, you get a higher return. And there are basically 4 areas of structural reform that I think are crucial to this process. The first is financial liberalization. And the concept here is very simple. You've had a distorted interest rate structure where the government keeps interest rates deliberately very low. And the idea is to allow capital-intensive projects to borrow money at very cheap rates so that you can build your railways and your ports and your steel plants and so forth very rapidly and at relatively low cost. And that's fine when the main job is building railways and roads and ports and steel plants. But when you need to finance higher productivity investments in consumer goods and services and so forth, this no longer works. So you need to liberalize the financial sector so that interest rates are set by the market, so that depositors in the banking system get a fair return, and so that banks and other lenders, other providers of capital, are forced to find projects that will generate a higher return. So financial liberalization is the first and probably most important component of the reform package. The second component is competition. And I want to pause here for a moment because I think one of the great insights of Chinese economic policymakers over the last 20 or 30 years is that in some ways they understood better than many Western economists what is the basis of growth in a modern market economy. Because like many other communist countries in the 1980s and early 90s, China was trying to find its way from a socialist model to a more market or capitalist model. And they got a lot of advice from Western economists. And typically, the Western economists focused heavily on ownership issues. And they said, you know, your problem is, in a socialist economy, the state owns everything. And so all you have to do is privatize everything, and private ownership will solve your problems. And a lot of the countries in Eastern Europe and the Soviet Union, for example, the former Soviet Union, that followed this advice did not wind up very happy. Because what happens when you privatize in a system which doesn't have the institutions, the commercial institutions, the judiciary to enforce contracts, et cetera, you basically replace a predatory state with predatory private oligarchs. And so private ownership in and of itself actually does not solve the problems. What the Chinese recognized, though, was that the key to a market economy is competition. And if the problem in a socialist economy is that the unitary state owns everything and there's no competition. And what they saw is that if you increased competitive forces, it didn't matter who owned the businesses. If they had to compete, state companies could also respond to market forces almost as well as private ones did. So they said, we're not going to privatize so much, but we are going to introduce competition. And when they did the first round of state-owned enterprise reforms in the late 1990s, the key fact, or the key tool that they used was in each of the major sectors where they wanted to keep state ownership, so things like aviation, telecoms, heavy industry, power generation, petrochemicals, et cetera, they said there's not going to be one state company, there will be 3 or 4 or 5. And so they created competing entities, and as a result of that and other policies, the efficiency within the state sector improved dramatically. So competition has always been the key to success, and now you need to have a next stage of reform to improve competition. And this actually does have a little bit to do with ownership, because now, after all these years, the state-owned enterprise has improved a bit, but basically the improvements have run out. And they have entrenched their positions in certain sectors, and basically you need to open these sectors that I just mentioned that previously have been dominated by the state. You need to open these to additional competition from private sector companies. Because the efficiency losses from state domination of these sectors are now becoming larger and larger. So that's one element of improving competition, is to open up previously state-dominated sectors to private competition. The second component is local governments in China at the city level and at the province level have considerable power to obstruct competition by protecting their local companies from competition from companies from other cities or provinces. And local governments will protect a local state company. They'll also protect a local private company. So this is not to do with ownership. This has to do with just simple protectionism. And what this means is that if I'm the most efficient company, and I'm based in Province A, and I want to expand into Province B, the government of Province B probably won't let me do this because they're afraid their local champion will go out of business, or I'll want to acquire it, in which case the tax revenues will go to the government in my province, not their province. So there's a lot of obstruction to the ability of companies to operate in different provinces or regions of China and to achieve the maximum economies of scale. So that's a barrier to efficiency, and it's a barrier to capital movements across provincial lines. So you need, in addition to financial liberalization, you need competition reform so that private companies and the most efficient companies can have the full scope of operation. The third component of reform is that you need to change the tax structure of the economy. And again, this has to do with local governments. Local governments, because of the nature of the taxes they collect, have an incentive to invest heavily in heavy industry and in land speculation. And this is not, at the moment, what China needs. What China needs is more incentives to invest in consumer businesses and services. But the tax structure provides no incentive for local governments to promote these industries because they can't generate much revenue from those industries. So you first of all need a reform of the tax system so that the revenue sources of local governments are more aligned with the types of economic activity you would like to promote. The second component is that local governments have a structural deficit. They collect a minority of total government revenues. They were responsible for a majority of government expenditures. They're always in deficit. They're always scrambling for new sources of revenue. This tends to make them somewhat predatory. And so you need a more balanced fiscal structure that enables localities to run a balanced budget. And the final component of reform is that there are a number of key inputs, notably land, water, and especially electricity prices, which are not really very market determined. They're still very heavily politically influenced. And so again, it's very easy for local governments to subsidize heavy industry and infrastructure projects by giving them cheap land, cheap electricity, cheap access to water, and so forth. So again, you need to change the pricing mechanisms for these inputs so they are set by the market. And again, that will tend to reduce the amount of investment in heavy industry and infrastructure and increase the incentives for investment in services and consumer goods industries. So the question is, I think this reform package is not something that I made up. This is basically something that's talked about in Beijing and China all the time. Most economists, many government officials recognize that these are the major issues. So this is not a mystery to anyone. If you do a sort of report card of how are we doing on each of these reform areas, I think what we can say is that the trajectory on financial liberalization is quite good. We've seen a lot of progress in the last few years, and so you basically just need to continue on that path and it will be fine. Input prices, there's been some progress in improving the pricing for land and refined oil products. The main problem is electricity reform, so this is like 50-50. In terms of competition policy and fiscal policy, there have been no progress for the last 6 or 7 years. So these are the key areas for the new Chinese leadership. And so the questions are, first of all, will they decide that they actually do need to pursue these reforms? So do they have the intention to continue with these reforms? And then the second is, do they have the political ability to make these reforms happen despite opposition? And my view is that, yeah, probably they will pursue these reforms, at least to some extent, and probably enough to maintain growth at a pretty solid level for the next several years. But it's not a guarantee. And I think, as I mentioned before, the main reason to think that they will pursue a reform agenda is that the legitimacy and the continued hold on power of the Communist Party regime is dependent on sustaining a high rate of growth. That's number one. Number two, the traditional tools that the government has used over the last decade to support growth are no longer effective. So as those tools